Hey guys, and welcome to today's strategy development session. Now, if you haven't been to one of these sessions before, I run them every week, and what we usually do is we usually go over a trader in the community or a trader in the audience. We usually go over their Darwin, we look at their track record, and I try and highlight things from kind of a statistical perspective, looking at different variables as the things that the trader can improve. Now, I am aware that these sessions are probably very similar week in, week out in terms of if you've watched one, you've watched all of them, basically. The only difference being that, we have traders who have different approaches. Some are algorithmically based or base their strategy around algorithms, whereas others are more discretionary and execute from a manual perspective. Now, there's two approaches that I can have when I analyze their Darwins based on whether they are an algorithmic trader or a discretionary trader. And I want to try some new things in terms of content for you guys and the sessions that we run. And so what I would really like to try is, yes, doing some Darwin analysis as well, but actually tying in some technical stuff too, in terms of actually figuring out when we're looking at the variables on the Darwin, when we're looking at the metrics that you look at to improve, how do we actually translate that over to a chart or to analysis? So today is going to be a little bit different, and I'm kind of going to let the session come naturally. I don't like forcing things. I don't like I don't like I don't know the way to kind of explain what I'm trying to say. I like to let the sessions go with the flow. I like to keep it very chilled, and I like to give you guys what you like best. I'd rather not force a session on all the viewers to just say that we've done a session. So if you want me to take a look at your Darwin, I'm more than happy to do so, and feel free to pop it in the chat, whether you're watching on Instagram, Twitter, Twitter and X, same platform, YouTube or Discord. Okay, so Sana Pianta, I remember last week I did say that I would take a look at your Darwin. So we'll go through your Darwin, which is IJHC. So we'll take a look at your Darwin. We'll take a look at some metrics, and then maybe we'll jump onto some chart work after. So the first question I'm going to ask before we bring it up is: are you an algorithmic trader or do you execute manually? Okay, so you do trade with algorithms. Okay. It always makes these sessions a little bit more difficult purely because there's less that you can change straight away, and algorithms always a little bit more difficult to decipher the behavior that's going on behind the scenes. But for sure, we can take a look at your Darwin and see what's going on. Marto's also asked, "Hey Kieran, I have a question. Shoot, dude, just stick it in the chat." And whilst I pull up this Darwin, I'll give you a moment to post it in there. So IJHC is the Darwin. Okay, so solid start, 21% return, 4% drawdown. That's fantastic. I mean, that's really, really solid. I can see you're a part of Petco's tribe, which, I mean, if I'd have seen that before I asked you if you traded with algorithms, then I would already know my answer. Is this a singular system, or are you trading multiple strategies under kind of a portfolio? So in terms of you've got multiple EAs running on one account, or is this literally just one strategy operating on its own? Multiple EAs. Okay, good, good. That's one thing that I always say, and actually I'm doing myself right now. So this is one of mine that I've built recently, which is a portfolio of strategies. It's yet to go live, so I'm 10 days in of having it on Darwinex, or Darwinex 0, I should say. We're currently up 1.24% with a max DD of 0.24. I feel like I'm going to be scaled up heavily because that's trading with super low risk. But having ran it as a portfolio, and having built portfolios in the past, I really, really love the idea of having uncorrelated systems all running separately, lower risk in terms of having, rather than shooting for a system that does 20, 30% per year, maybe with a slightly larger drawdown and putting all your eggs in one basket. Actually, when you're building a portfolio, what you can really do is go, I need 10, 15, 20 strategies, all returning 1 to 2% per year with a really low drawdown. And that's much, much easier to build. You're less reliant on a specific market, a specific asset, specific strategy, and you let the portfolio kind of do all the heavy lifting for you. So before we get into the analysis, Marto's asked, what is the maximum allowed open trades for a normal Darwin account at a certain moment? So there is no maximum allowed open trades to my knowledge. I don't think there's a physical number because it's all dependent on your margin. So dependent on the margin of the asset that you're trading will determine how many positions that you can open before you run out of free margin, and you're kind of, yeah, you'll get margin called. You know, so you could open 2 10-lot positions perhaps, but 100 0.01 lot positions, and it would be the same margin requirements for both of those trades or set trades. Now what we do is we measure your exposure via your position as opposed to a trade. So we take a look at all of your positions, we create a synthetic position risk adjusted to the euro dollar, and then we calculate your deleverage based on that, and that's kind of how we would measure your risk exposure. So it's not determined by the amount of trades, but it's the exposure or the size of your position as a whole. Now let's take a look. I hope that's I've explained that well for you. So let's take a look at IJHC. So another question I'm going to ask, because it's EA based, and I hope the answer is no, but you know, it's okay if it's not. Are any of these systems grid or martingale? Because I would hope they're not. It's just, you know, we can never know. The problem is with grid and martingale is you can have a record that looks like this and then in one day can be a huge slump. That's why I'm asking, because this record looks pretty stable. The answer is yes. Okay, so there is grid and martingale. Yeah. Okay, so it's okay. It's not saying, I'm not saying that it's necessarily bad. I mean, grid and martingale systems inherently are higher risk, and they are basically playing on the fact that the market will always revert to the mean, which doesn't always happen. Now I've seen grid and martingale systems running for 5-6 years and then all of a sudden have a 70%, 80% drawdown. So those things can happen. However, the fact that you're running this within a portfolio already reduces that risk. The fact that it's risk adjusted by the risk engine also reduces that risk. So yeah, really low risk. Yeah, I'm not overly concerned at this point. The fact that you are including a grid and martingale strategy in your portfolio. Just be aware that, you know, at some point your max drawdown could just out of nowhere double, triple, quadruple, and it can affect your ability to get allocations moving forward. You know, if your drawdown's a lot larger than it is now. So it's just something to bear in mind, but just monitor the strategy. You know, make sure it's not getting too deep into drawdown or too deep into a position, and just manage that. And if it starts to, then maybe just hedge the position, open up some manual trades to try and hedge it and work the way out of it. Because yeah, you don't want to get into a grid spiral. But of course, it's your strategy, so you know, do what you do best. Stop loss is set anyway. Okay, fantastic. If it's got a stop loss, ignore everything that I've just said. Motto's just said, I meant classic account, so for classic Darwin, it depends only on the margin. I mean, there's no real difference between the Darwinex and Darwinex Zero when it comes to account usability or stuff like that. But yeah, like any account, really, I mean, I could be wrong. I don't think I am. I don't think there is a position limit. I think it's based on the size of the trades, right? Like any account. I mean, we can double check. Let me bring it up now, because I don't want to be giving you false information. Darwinex K-base. So on Darwinex Zero. Position limits. Let's take a look. Yeah, I don't think there is. Yeah, I don't think there is any position limits, other than what you're bound by when it comes to margin and leverage. So of course you can't just open up 400 trades at 10 lots each. It would be based on how much you can actually open with your margin. Now let's take a look. Allocation. Okay, calls. You've currently got 115,000 euros. Your peak was 150,000 euros, which is absolutely solid. Your record, all green months thus far, 3. So you're coming into your 9th month. 5, 6, 7, 8, 9. So you must be on track to hit gold this month, right? Oh, wicked. So at the end of this month, you'll hit gold. Tanisha said they do stop you if you run out of margin. Yep. Yep. Been with them for about a year. Yeah, that's it. It's all based on your margin. So again, you could have 1,000 trades at 0.01 lots or 0.01. Well, it wouldn't be 0.01 contracts, 0.01 lots, and that would be the same as having like 10 trades at 10 lots, right? So it's all dependent on your margin, not the actual amount of trades that you have open. Yes, so you're going to be in DarwinIA Gold, which is fantastic. Hats off to you, dude. Allocations get bigger, allocations get longer, investors, or you're at least open to investors. So you're then available on the investor marketplace, which is solid. At the moment, you've got a Sharpe ratio of 4.27, which is ridiculously high. I mean, is it reflective of a longer period? Probably not. 4.27 is ridiculously high. But this is obviously looking at an 8-month period. So that will probably gradually come down, but still it's probably going to stay way above the average anyway, or what you would expect to see, which is 1.52. So great work there. Maximum drawdown. I mean, that's solid. 4.21. Great stuff. Absolutely great stuff. Let's take a look at what you trade. So, oh, interesting. So it's all FX pretty much. We'll ignore the commodities because you've done 3,500 trades on FX and 22 on commodities. So I'm less bothered about those. And it only accounts for 1.73% out of the return. Interesting. So is this one system? Oh no, we've already discussed. So are you using a portfolio of strategies all trading euro dollar? Which I mean, I presume that's what you're doing. It's a system that's been removed. Okay, so the gold system's been removed. So now I'm presuming that you have multiple strategies all running on euro dollar, which I mean seems to be working. 74% win rate with a 21% return almost, which is phenomenal over a 3,500 trade period. So really solid stuff. There's nothing to even talk about there. Usually I compare good assets to bad assets unless you're hedging yourself with assets where you're underperforming. In terms of sometimes we have traders who will trade multiple systems on multiple assets. When you look at it at face value, it might be like, why you're trading CAD yen or Euro CAD. And the reason that they do it is purely to hedge their main strategies. But with you have one system or at least one asset, so there's literally nothing to discuss here. Take a look at the trading time distribution. This gets difficult for EAs because unless you have a specific time window coded in where your system will only take trades during certain time periods throughout the day, it's kind of difficult to say you should stop trading here, you should stop trading there, because that is part and parcel of the expert advisor, right? Or the robot that you're trading with, the fact that it just executes when it sees an opportunity. Now, this is quite a confusing metric as well, because it says number of trades and then gives you a number, but this actually counts for trading decisions, so opening and closing of trades. So you haven't actually executed 3,177 trades during the European session, but what you have done is either opened or closed a trade 3,200 times. Now you can see that your best 2 sessions are the European and Asian session, whilst you underperform during the US session. Now, what you could do with this is you could try and decipher, is this through executing in this session or is it through closing trades in this session? Now, the way you would do that, or the way I would do that, is trying to add a time element into the system. So you can either do it where you'll run a back test and then download all the data, filter the trades by session, so in between this hour to that hour. Or if you have like the MQL5 code, maybe stick it into something like FX Streamer or EA code. What's it called? There's a few different platforms that you can put in and just add a new element to it. So add a block in, reprint the code, and then run new backtests on it and just add a specific time element. Run it only executing through the American session. See if the results are positive or negative. Because if they're negative, you know that when the system executes during the US session, that's when the majority of losses are made. And then to find, if that's positive, okay, well, we don't stop it from executing during that session, but then test it where you don't close any trades during the US session. So always close in the following European or the following Asian session, for example, and see if that changes the metrics too. Because what you can do is put blockers for positions to be opened and closed unless it hits, a hard stop or target or something. Just because there's quite a big disparity here between your best sessions and your worst session. I mean, your best session to worst session, there's like what, almost 15% disparity, where the Asian session's giving you a huge return, but the US session's kind of, well, it is lagging. And I would be wanting to find out why that is. Not necessarily so that you can make every session profitable, but if there's a certain time of day where your expert advisor is taking trades where it shouldn't be, or where they're much lower in probability, I'd want to be reducing that, or at least reducing the size maybe at that period of time. And now we get, this is all easy in theory. There's certain coding that needs to be done, or there's certain things that you would have to fiddle with. But I'm just trying to spitball ideas of how you can level this out, because what I would like to see is at least it to be green, but not to have such a big disparity between the good sessions and bad sessions. So he says, there's a couple of comments in Discord. Yanis said, I did calculate my EA's VAR with AI and I managed to bring it to Darwinex 0 levels with a historical max drawdown of 15% and CAGR 15% for 17 years of backtest. What other factors should I look at? I would just get it trading. I would just get it live on Darwinex or Darwinex 0, and then see the metrics for yourself when it's actually trading live. I wouldn't worry too much about checking everything beforehand. I would just get it out there. If you know that the system's profitable over an extended period of time and the risk is managed, I'd just get it trading and then take a look at the metrics when it goes live. Sanapianta again said, I agree. Sometimes I am interfering manually. It's rare. I guess the US session, it's when I did it. Okay, so I presume when you're interfering manually, it's either closing trades early or, well, yeah, probably closing trades early, which, correct, or hedging. Okay. So that could explain it. I mean, it's still a pretty big gap between the return from that session to the others. Again, if you run some back tests and add a time filter or just filter out the performance by that time, take a look, see if there were any trades that you did yourself, because you might find that if you've accounted for 5% loss by interfering or trying to hedge or doing whatever you've done, well, at least you would have been in the green for that session. And whilst it's not a major change, you at least know that passive management for you is better, and you best just let your system do its thing. So you take a step back and you don't interfere. Alternatively, if you find that not executing trades throughout the US session boosts your performance, well, cool. Stop the system from running during the US session. Even if you don't have access to the source code and you can't change it, you can just go onto your MetaTrader, turn off auto trading, and then turn it back on after that session. It's all kind of if buts and maybes. This is something that you don't have to do. It's just something to be, aware of. It concerns me that the performance is so poor compared to the other two sessions. So it's definitely something that I'd be looking at. And I'd be trying to think out of the box how to test it. I've already tried that, various back tests and stuff that I've mentioned, but I would be trying to think of way. I would get obsessed with these minor variables, and not to the point where you're doing anything to get over them, but get obsessed with thinking outside the box. Get obsessed with thinking about new ways to improve the system. Because again, it's a bit of a red flag that they're so different. Like if it was a couple of percent, I'd be going, well, it is what it is. It's just a worse session. But because it's so different and it's so poor in comparison, I'm like, there could be a reason as to why that is. Might be coincidence, but I for sure would want to know. Return distribution by day of the week. I like how consistent this is. You tend to find that with automated systems anyway, is that there's not much difference on by day of the week. Obviously, your standout day is a Tuesday by far, really. I mean, it's way above the others. The rest are pretty consistent, but there's nothing really to be concerned about here. I mean, they're all consistent. They're all in the green. So there's nothing that I would be like wanting to look at urgently on this. The only thing is maybe if you want to understand kind of in a little bit more depth, take a look at why Tuesday is so good. I mean, it looks like whatever trade you took here kind of gave Tuesday a massive, massive boost. And what I would be doing, again, trying to think outside the box. And a lot of these ideas that I present and a lot of the things that I say, it might go no. In fact, a lot of them will go nowhere and it won't lead to a resolution or it won't lead to a change. But they're things that maybe you haven't thought about before. It's variables that maybe you haven't checked before. I know specifically manual traders, a lot of them just refer to a chart and how do I stop this from happening? How do I do this? How do I improve? And they'll always refer back to that one variable, which is a technical pattern. I don't like to do that. I like to look at statistics. I like to look at or understand my data. And like outliers like this just stand out to me. Okay. So I'd be looking at this trade. So figure out what day it was, what asset it was. Well, you know what asset it is. It's euro dollar. I'd be going and looking at that trade. Is this repeatable? Can I do that again? Was it a red herring? Like, find out why that's an anomaly. And maybe these trades here as well, this one and this one, or these couple of trades. Like, look at the spikes and try and figure out what happened. Okay, even if it's benefited you from a return perspective, take a look at what's happened. Can you repeat it? Can you build systems around it? You know, if it's going the other way, like this big drop off, can you hedge against that? Is there ways to counteract it? Just always look at trying to get these as stable as possible. Again, I don't think there's anything to be concerned about. I am nitpicking, but like the anomalies, I always check anomalies in my trading, because if it's an anomaly, that means it was either an anomaly from the market or from my own behavior. If I take a look at the market on that day and I was trading without a target, and then we had an interest rate hike from the Fed, and I was, I don't know, long equities, for example, or short equities or what have you, and it ran 5,000 ticks in my favor, well, of course, yeah, we're going to see a big spike. But if it was something that I did, whether good or bad, I want to know, because I want to know how to stop negative behavior from affecting my performance long term. And I also want to know what benefits me. Okay, what have I done that's clearly worked in the past, and is it repeatable? Can I do that again? Again, this is all a little bit more difficult when you're trading with automated systems, but it's still possible. You can still do it. Wow, your system is active. So your daily trade frequency on average is 23.28 trades. So on average, you're taking 23 trades per day. Like that's huge volume. 55% long exposure, which is on euro dollar, you would expect roughly 50%. I wouldn't like to see too much skewed in one favor. Like if it was above, 58, 59, 60%, on an FX pair, I would be slightly concerned. Indices and commodities, of course, you're probably going to have a higher long exposure than you are on currencies, unless there's some like mad trend like we see on yen pairs over the years. But that's pretty good. Percentage win rate is 74% almost, which for when using automated systems, like 74% win rate is solid. You do have a negative payoff ratio of 0.59, which for anybody who isn't aware of that terminology, payoff ratio is basically risk to reward. So you have a negative risk to reward per trade, but that's commented by a high win rate, and that's always the case. You always sacrifice one to have a good other one, right? So it's very rare that you'll find somebody with a high win rate and also a high risk to reward. If there was a system that had both, every single person would be trading it right. There is a question in the Discord before I continue from Sam Jr. Hello, do I need to subscribe monthly fee after I pass my 100k permanent allocation? Yes, your 100k permanent allocation is a separate product to the subscription. So your Darwin is based on the subscription. The 100k permanent allocation is an add-on. So that's a one-off payment which will be with you forever as long as your Darwin is active. So yes, monthly subscription is for life unless you migrate to Darwinex and open a live account. At that point, you wouldn't need to pay a monthly subscription. Your average, this is interesting. Your average losing trade duration is 17 hours and 45 minutes, whereas your average winning trade duration is 3 hours and 40 minutes. Now, that would say, that screams grid / martingale to me, again, because it's giving you a massively negative duration ratio of 0.21. The reason that tells me it's a grid / martingale system is because they tend to take small winners and then it will work out of its losers. So if it goes into drawdown, it will stay in the trade, it will open a new position, and it will wait for it to turn into profit. So that's why the losing trades will be longer than the winning trades. Just be mindful of that, because I mean, if you're martingaling in, DCAing, whatever you want to call it, it's kind of unavoidable. But what you can do is, it's a tough one, because if you keep the martingale, there's kind of nothing you can do. But if this was me, I'd be looking to see where my expected value goes up and down based on how long I'm in the market. So because your average losing trade is far longer than your average winning trade, the longer you're in the market, the lower expected value that you have. So, but again, that's kind of counteracted by the fact that you're martingaling in. So it kind of doesn't really matter, because you're playing the odds. I mean, it's risky, but you're adding size when you're wrong. So at least when it turns around, you're still going to make money. So it's kind of a difficult one to combat, knowing that you're using that sort of technique. But yeah, you can see the majority of your winners, so 1,700 winners, are within a 10 pip range under 30 minutes. So your system likes to be in and out, in and out, in and out. But then, when things go bad and it starts to go into drawdown, it'll add more size, add more size, add more size. So it's a bit of a tough one. So I'm not really going to dwell on it too much, because I don't think there's much you can do about that. What I do like to do, though, as I say, is just figure out where my expected value is highest and where it's lowest. Maybe implement a risk barometer, maybe scale out of trades as I know my expected value is dropping. For example, if I know that I'm more profitable down here within 4 hours of being in the market, and then let's say my win rate drops after 4 hours, I know my expected value is less. Okay, so I start going, okay, is there a way to close this trade early? Is there a way to scale out early? Sam Jr. has just asked again, is there any possibility the current permanent allocation of 100k could change higher in the future? Yes, we are looking to release some boosters soon, which will be temporary and permanent, so that we are going to be increasing the amount of allocation that you can have. Final details are yet to be released. Even to me, I'm not sure of what the final scope of that product is going to look like, or when it's coming. I just know it's coming soon. Wazmataz, monthly withdrawals are pretty much next to come, so that should be coming pretty soon. We also have the index that's being released soon as well. Those are kind of, I would say, within the next month, hopefully, but I've been saying that for like the last month. But I'm confident that it will be, if it's not May, it should be June for monthly withdrawals at least. Then boosters will probably be after that. But again, I can't promise too much, because I don't know myself at this point. Again, this kind of screams martingale. You can see that the winners are all relatively small, and then we have a couple of really big drawdown periods here. It's unfortunate you can't scale into this chart, because I'd be intrigued to know where he closed out, but I'm presuming at some form of profit on these trades, because there wasn't a drop off in your equity curve at that point. So yeah, this is again just the things I'd be mindful of trading grid and martingale. Is like, you can have these, and there's nothing stopping these red candles or this drawdown from blasting off the bottom of my screen here, other than the fact that your system timed it and managed to get back out of it. But just be mindful that does carry an immense amount of risk. And what the risk engine can do, if you're not already aware, is if it's martingaling into a trade, the risk engine can close some of the trade exposure whilst it's open, and therefore completely negate the effect of martingale. So whilst you're opening 0.5 position and increasing the size to counteract the loss from the first couple of trades, the risk engine might close the first couple of trades because you have too much exposure at any given time. So just bear that in mind. Keep the risk low. I mean, keep trying to run it as we're going. Alsana Pianta said there was, from my all-time high, about 2%. Yeah, but that's it's minor. That's barely anything, really, is it? I mean, that's like somebody risking 1% a trade and losing 2 trades in a row. Wouldn't even be concerned about that. Sam asked, is there is there a possibility the performance fees percentage could go higher in the future? I highly doubt it. We conform to hedge fund standards because Darwinex is a regulated asset manager, and we have real investors backing the traders and in the Darwinex hedge fund also. And you'll never find a real investor willing to take on less performance for more risk. It doesn't make sense. They'd just go and invest in the S&P otherwise. So I highly doubt that the performance fees will go higher. Value at risk currently sat at 12.32, solid. I mean, nothing to be concerned about. Anything under 30% on value at risk, I'm pretty much happy with. 30% and above, what we've seen over the past 13 years is that those traders are likely going to blow out at some point. And by blowout, I mean either blow up their account or go through a huge drawdown, which basically ruins their mental, ruins their ability to get investors in the future, and just makes them give up, right? So you're comfortably sat beneath that. If you went into massive drawdown and you just kept adding size and size and size, this might spike. So just be wary of that. But as it is right now, there's nothing to worry about. Maybe lower your risk at signal account level. So try and bring this as close to 6.5% as you possibly can, just to give you that breathing room from a margin perspective. Your Darwin will always stay out of the same result, even if you do this. But what I'm just thinking is if we can reduce your VAR, because you do grid and martingale, you don't want to run into any margin issues at signal account level. But all it would mean is that we lower your VAR and your risk multiplier increases so that your Darwin pretty much comes out at the same level anyway. Just an idea. You don't have to. It's not a concern being at 12% anyway. I wouldn't even be bothered. And if it was my system, I probably wouldn't even go through that. But you wouldn't want this. You wouldn't want to see this go higher, basically. Not trading grid and martingale anyway. I did it waiting for the VAR to adapt. Okay, cool. How much is Sanopianta VAR? 12.5% pretty much. You can see from my monthly percentage lately. Yeah. Wazmatas has asked, since your company emphasizes a long-term approach, what is Darwinex doing to ensure they are around for the long term, like going public and having a board maybe, so the company outlives the people that run it, though I wish you all a long life. Okay, so, I mean, we already have that to a degree. I'm not sure about going public. Not all brokers are public. We have enough regulation in place and we have a big enough team. Darwinex has a team of 80 to 90 people. We're not a tiny company. We're not a small company by any means. And we've been around long enough to know how to future-proof the business. Put it into perspective. We have a broker with thousands of traders trading in it, with over 100 million in AUM from external investors. Now, of course, we earn broker commissions from that. We earn a percentage in management fee, performance fee from that 100 million. We have our own hedge fund where we have millions of our own capital as a company in there, backing our best traders. So really taking advantage of, the community that we built over the past 13 years, because the best guys, the top 200 guys are part of the index, which is our hedge fund, meaning that we're earning money from our top traders again. And then Darwinex Zero is kind of a nice addition to that pot where we have the virtual side of things, again, allowing us to expand into a market that really we've not really had much exposure to before. Now, of course, there's risks in any company like Darwinex or a broker that you trade with or a prop firm. Of course there's going to be risks, but I would like to think anyway we have a big enough and solid enough team who understand risk well enough to be able to future proof the business. For example, referring back to the profit fee, the performance fee percentage, could it go higher in the future question? If we put performance fees to 80% like FTMO or like any of these other prop firms, we'd probably go under, right? Unless we put our prices to $500 a month, you'd go under. There's a reason why prop firms make their accounts so difficult to pass and difficult to remain live with. And there's a reason why their prices are so much higher, because they have to cover their margins and costs, and they have to cover their risk book. It's a very intricate thing, but we have a whole team dedicated to the company risk and to building a future for us all. Bear in mind that we're regulated by the FCA, CNMV, and FSA, so we have a lot of eyes on us as a business. You have to lock up a lot of money to get those regulations, and you have to adhere to so many different rules and restrictions. But are there shareholders in the company? Yes, there's shareholders in the company. And we're always like, looking to collaborate with other companies or other shareholders as well to boost the business. There's some big things going on behind the scenes. There's some exciting stuff, but there's things that's kind of in early development, so we can't talk about it. But there's a lot going on behind the scenes from Darwinex. Sam asks, can you explain details about VAR? I'm a bit confused. Okay, so value at risk essentially measures your risk exposure as a trader based on 4 different things: the volatility of the assets that you trade, how many times you trade, how long you sit in those trades, and your position sizing. That spits out a number, which is your value at risk, basically meaning how much risk or exposure does this trader take to generate a return. For perspective, the S&P 500 has a value at risk roughly around 6.5%. So what Darwinex does is we have a risk engine that takes all of your trades and trading activity, copies it to your Darwin, which is basically an index that investors can buy into, takes all the same trades, but risk adjusted to the value at risk of 6.5%, meaning that your trading strategy is the same risk as the S&P. But if you outperform the S&P, then investors can buy into. If you don't outperform the S&P whilst using the same risk as the S&P, well, an investor shouldn't invest into you. It's simple as that, because they could go to the S&P 500, which is probably the most liquid and highly traded investment asset in the world, or one of, and it just makes sense to park up your capital there. If you prove that you can outperform it with the same risk, then of course you're going to attract investors. Yanis, thank you for sending the documentation in for VAR. I appreciate that. I've also put, there's a channel in the Discord called Darwinex 101, where there's a load of training videos. I've made them all 30 to 60 seconds long, covering things like VAR, deleverage, all those sorts of concepts. They're also on our social media, Instagram, TikTok, YouTube, X, all these different platforms. So make sure you go and watch those. Like I say, they're 30 to 60 seconds long per video. And I try and break it down into like bite-sized chunks of information. So sometimes it's better than reading a document. Where's Matthias? I'm just thinking in terms of long term, like a Charlie Schwab. Yeah, I mean, hopefully Darwinex is around forever, and hopefully it does outlive everybody who's working on it right now. I guess it's our job who are working for Darwinex now to future-proof the business and to keep it here forever. I mean, me personally as a trader, I think that the Darwinex business model and product is fantastic. Historically, there's been a bit of poor marketing where the marketing hasn't been done right, and things are a little bit complex and stuff. But I think if we tackle that and we get Darwinex out to everybody, it will become the new gold standard, period. So yeah, Sana Pianta, thanks Kieran for your analysis. It was very helpful and I will try to improve. I mean, we haven't finished yet, dude. We've got 20 minutes left and I was going to run through your investable attributes on Darwinex.com, unless you've got to rush off. If you're not aware, you can view your Darwin from Darwinex Zero on Darwinex.com. So you can log in using your Darwinex Zero login, or you can create a new one. It's completely up to you. And then you go Darwinex.com/Darwin/ your 4-ticker Darwin, and then put a hashtag at the end. The hashtag, I don't know why it works, it just does. And it will come up with a screen like this. So you'll see your 4-ticker Darwin, and then you'll see buy zero here. So it's just showing you that this Darwin isn't created through Darwinex, meaning there's not a live account. It is traded through a virtual account, and it is provided by Darwinex Zero. Sam's asked, so far, what is a higher allocation from an investor that's received by a Darwin? So the highest allocation that we've ever had from an investor to a singular Darwin was 38 million, and that was the THA, but that was for a Darwinex Darwin, so not somebody through Darwinex Zero. That's correct, Yanis, through Tails or Thales, however you would say it. His name's Atu, but he owns a company called Tails. But he was managing 38 million at one point. He's been around the block for 10 plus years, so he has a super long track record, and he was a favorite for the majority of our investors for a long time. In terms of from Darwinex Zero, I don't know off the top of my head the maximum investment that somebody has or has ever had. We've got guys managing $500,000 at least on Darwinex Zero, like PGLM. Some of that is DarwinIA, some of it, the majority of it is investor capital. But as I say, I don't know off the top of my head. The problem is with Zero is it hasn't been around as long, so a lot of the allocations are smaller. in terms of investor capital. There's track records for 5, 6, 8, 10 years on Darwinex. So whilst the zero track records are kind of catching up, they're slower to grow. But I presume in 2, 3, 4 years, you'll probably see zero Darwins taking over, because the performance of zero Darwins generally is better than a lot of our classic users anyway. So let's take a look. So we have these different investable attributes on Darwinex.com, and they just basically measure various metrics that you probably wouldn't have even thought about. So I do need to head off at 5. It's my mum's birthday today, so we're gonna go out for some food. So I do need to head off in 20 minutes, or maybe even 10 minutes earlier. So I'm gonna try and blast through these as quickly as I can while still giving out all the information that you need. So experience basically measures how much experience we have on you as a trader. This is measured in D periods. So based on your trading activity, and thank you, Yanis, appreciate that. Based on your trading activity, i.e. how many days you've traded and how many trades that you've taken. It's not a score that you're going to get a 10 out of 10 on day one, because we need more data. That's all it is. So the fact that you got a 4.4, I wouldn't worry. Just keep trading, and then what you'll find is probably in a year's time, this will be a 10 out of 10. All we need is more data. It's based on D periods. So you can see you've got 5 D periods so far using your trades and the amount of days that you've traded. As soon as that's up to 12, you'll have a 10 out of 10 score. So nothing to worry about. Some people get concerned, message me about that. I'm like, it's literally nothing to be concerned about. The next one is market correlation. So generally, unless you trade long only ETFs or stocks, you will have a high market correlation score. So you have a 9.9. Usually we see anything above 8 to 10. And it basically measures your efficacy of trading both sides of the market. So does this trader trade long better than they trade short, and vice versa? The reason I say about the long only stock and ETFs traders is because if they're going long only, of course they're going to underperform in a bear market and overperform in a bull market. Just nature of the beast, right? So they're going to have a poor market correlation score because they're not going to be able to go short. Now, next is risk stability, which we've already looked at, which is your value at risk. You've got quite a low score on that, which I'm not sure why. I don't think your value at risk is that unstable. I wouldn't be too concerned about that. It's giving you a 3.1, but maybe time will tell. Maybe that will level out. Next is risk adjustment. So you've got a 9.9 score on this. This measures how many times the risk engine has been intervening in your trades. So as I mentioned earlier, if your deleverage expands and you have more exposure to the market than you do usually on average, the risk engine can close some of your exposure early. So each of these green dots represents a trade. The red ones are where the risk engine got involved, and the orange ones are too. So you can see if you hover over them, it tells you how much the risk engine adjusted of that position. Then we have opening and close strategies. Now, I'm going to recommend you read the K-base for this because I don't always give this the justice that it deserves, but it basically measures, would you be better off getting into the market 10 to 50% before or after you do? Now, it's relative to the average trade duration of your that you have, and it's very difficult to amend for expert advisors because especially getting into the market sooner, because quite often you have to wait for something to flash or flag a trade signal, and then you get into the market. So it's sometimes difficult to get in prior to when that signal would happen or would occur. But yeah, I mean, you have the top scoring metric for closing strategy, which basically means that you're getting out of the market better than if you held trades for longer or cut them shorter, but you're about mid-table for getting into the market. So if you got into the market sooner, you would be better off. But like I say, it's very difficult to improve on that metric. But definitely check that out anyway and take a look at the K-base. Now, the next three, the positive, negative, and duration consistency, we've already been over that. It's the blocks that were on Darwinex 0. It's just displayed in a different way. The loss aversion is the excursion chart, which we've already looked at, which leaves us with 2 attributes left before we finish off this session. So last but one is we have a performance chart, and you're currently ranked 9.7 on this chart, which is great. And you can see this is just a Monte Carlo test, comparing your Darwin to 10,000 random strategies all operating with the same risk. Basically measuring how you perform compared to 10,000 systems, all using the same risk that you do to generate a return. You're currently sat at the 97.76th percentile, meaning that you're outperforming 9,775 other systems, or using the same risk. What I like about this Monte Carlo test or this performance chart is that it gives you pretty much instant feedback when you make a change. So if you start improving your strategy, adapting or updating certain things in your parameters, check out what happens on this Monte Carlo test. If you see it spike to the downside, maybe you know that the changes that you made probably aren't the best thing to have done and you can revert them. I mean, I'm not saying after one trade, but like let it play out for 10, 15, 20 days, maybe, you know, get 100 trades under your belt. If the Monte Carlo is dipping, you know that it was a bad decision. If we see it boost up, okay, double down on it, right? So the reason I like this is because it gives you instant feedback. Now, last but definitely not least is your capacity. And a lot of people don't know that we actually measure this or what it means. But your capacity is essentially your alpha cap for your trading strategy. So how much capital can you manage as a trader? Now, this is at risk adjusted level. So if you're being tuned down, of course, you've got to take that into account as well. But what we do is we measure the toxicity flow of your trades and your orders. And we measure how much slippage an investor would get on average. Now, based on that slippage, we would cap your trades off, determine based on how different their return would be, an investor's return would be compared to your Darwin. So we can see at the top, the divergence sensitivity. This measures the difference in performance based on the toxicity flow of your orders. So your Darwin on the last calculation, May the 12th, your Darwin was up 19.68%. If an investor was getting 2 pips worse fills on every trade, they would actually be down 3.72% over the course of the past 9 months, which is a pretty big difference, right? So you're up 20%, they're down 4%. Now, obviously, we have to take this into account because we're marketing this strategy to our investors. And because we're regulated, we can't advertise a system that isn't going to perform the way that, you know, we're marketing it and we're displaying it as. So what we do is we put a cap in place so that we won't let you manage more capital than we know that your system can handle. So if we scroll down to max estimated investment, you can see that it spits out a figure. And currently your max alpha cap is sat at 36.5 million, meaning that before your investors start getting slipped to a point where their performance is going to be significantly worse than yours, you're going to have to fill up your strategy with 36.5 million before that happens. So you've got a way to go. 36.5 million, I probably wouldn't ever be worried about that. I mean, it's a great problem if you get to that point. But this is something that you usually don't worry about until it's too late. And if it's too late and you've got a max investment of 100K, then you're basically going to start from scratch with your strategy. Where should I sign? I mean, I might be able to give you a couple of £100 to that max investment. see if we can fill that up for you. But yeah, that's all of the investable attributes on Darwinex.com as well. Sana Pianta, your strategy is fantastic. Like, you should be proud of it. Just try and keep it stable now going into the closing of the year for you in terms of when you're hitting the 12-month track record. You should be hitting gold this month as well. So make sure you keep up that. I think you just need to stay above 20% return. So don't let your Darwin quote fall beneath 120. Turn the system off if you absolutely have to, if you get into the last week of this month, just to ensure that you hit gold, because next month you'll be on for bigger and longer allocations. So guys, I'm going to love you and leave you here because, like I say, I need to go for my mum's birthday. But it was a fantastic session as always. And if you do have any questions or you want me to analyze your Darwin in private, please just don't hesitate to send me a direct message, and I can either do a session in private, record a video, or we can jump on next week for this session. We'll be back tomorrow at 4 p.m. UK time, I believe, or 5 p.m. for a Darwin explanation session. And so, yeah, have a fantastic rest of your evening, guys, and I'll catch you all in the next one. Bye-bye.